There's a transaction buried in Wall Street records that should be impossible. The SEC investigated it, Congress held hearings about it, and the world's best forensic accountants studied it for years, but no one can explain how it actually happened. By the end of this video, you'll understand why this case still keeps financial investigators up at night. Markets are, in theory, a public record of human decisions. People buy, people sell. The reasons are often clear. A company reports good earnings, a government announces new policy. But on one particular day, the reasons vanished. Prices for certain stocks lurched violently. They jumped up, they crashed down. The movements were too large and too fast to be normal. They happened without any obvious trigger. This left Wall Street's best minds with a profound and unsettling puzzle. A ghost had passed through the world's most sophisticated financial system, leaving a messy trail, but no name. The initial reaction was a search for news. They looked for a press release, a political development, an economic report that might have surprised everyone. But there was nothing. The silence was deafening. In a world saturated with information, the absence of a cause was more alarming than the effect itself. It suggested that the market's fundamental logic had been temporarily suspended. So the search turned inward, toward the market's own mechanics. Perhaps the problem was the market itself. The day began with the familiar rhythm of Wall Street. It was May 2nd, 2025. Coffee was brewed. Computers hummed to life. Empty trading desks and glowing monitors. The opening bell rang. Order flow floods trading screens. The first few hours were routine. The Dow Jones ticked up and down. Blue-chip stocks stayed in range. Algorithms executed trades, providing liquidity, absorbing small imbalances. Just another Friday in the financial capital. The calm was deceptively normal. Around midday, the first tremors appeared. Subtle at first. A mid-sized tech stock jumped 3% in under a minute. Then, an unrelated sector did the same. More securities began to behave bizarrely. Prices swung wildly, detached from fundamentals. These were ordinary mid-tier stocks, isolated but intense moves across different names. The scale escalated fast. A stock at $50 spiked to $58, then plummeted to $45, all within 15 minutes. Volume exploded. Millions of shares changed hands in moments, far above daily averages. On the trading floors and in chat rooms, confusion spread. Fat finger error, coordinated attack, or something else entirely. As quickly as it began, it stopped. By the close, someone glancing at prices might miss it, but for witnesses, the memory was seared. The market had briefly broken free from its moorings. The mystery is simple. What caused the sudden, violent, and seemingly reasonless price swings? In a normal market, large moves tie to new information. A failed drug trial sinks a stock. Blowout earnings send it higher. Information fuels price discovery. On this day, the engine roared with an empty tank. No major news, no significant corporate announcement, no surprising economic data release. Experts turned to the market's internal plumbing. The modern market is a fragmented network of exchanges and private venues, including dark pools. Dark pools execute large trades without immediate public visibility. The full picture is delayed and hard to assemble. No single regulator or participant has a complete real-time view. Records showed flurries of extremely fast small orders, classic high-frequency trading signatures, programs operating in microseconds. HFT can add liquidity, but also create feedback loops, amplifying small moves. The data resembled a swarm in a recursive dance. Was one program malfunctioning? Or did the system experience an emergent failure? Intent, or its absence, was the missing link. A large institution could have hidden a massive trade split into thousands of tiny pieces. If it was a technical glitch, no firm admitted it. If it was spoofing, evidence wasn't clear enough. The market behaved as if manipulated, but fingerprints were nowhere. The machine showed a ghost, and the ghost left no tracks. The first prominent theory blames a high-frequency algorithm gone rogue. A single program experienced a bug or consumed flawed input, for instance, buy below a threshold, without accounting that its own buying could lift prices and keep buying. Momentum algos join, amplifying a simple error into a chaotic rally. Speed and granularity support this. Millisecond movements and many tiny orders. Academics and specialists argue markets are complex adaptive systems with emergent behaviors. The mystery may be a system-wide cascade, a digital flash flood, but major firms have kill switches and risk controls. No one confessed a failure. The silence is suspicious. Activity clustered in a specific basket, suggesting some underlying, if warped, logic, not random failure. Perhaps multiple algorithms executed a similar flawed play, an unsettling consensus hallucination exposing hidden fragility. The second theory revolves around a human actor, a whale. An investor or institution with massive capital tried to move a huge position in secret. They iceberged, splitting into thousands of tiny child orders, routed across venues over a short window. The aim, disguised true size as random noise. Supporters see hallmarks of a masked build in a concentrated basket. They might replicate an index or execute a quant strategy quickly, the volatility an unintended consequence. But filings that would reveal it never appeared, and the execution seemed clumsy and costly. A darker variant, the whale aimed to trigger volatility to profit from options or derivatives. Shake the tree, force liquidations, then buy cheap, highly illegal, and hard to prove given anonymity and fragmentation. If the whale exists, it remains hidden in the deep. Theory 3. The derivative domino. Options give the right, not obligation, to buy or sell at a strike before expiry. When customers buy calls, market makers who sell them hedge by buying stock. This dynamic, gamma, can accelerate near key strikes. Small moves force more hedging, which pushes prices further, forcing even more hedging, a feedback loop. A large burst of options buying could trigger massive market maker hedging and uncontrolled surges. With options use exploding, especially among retail, a swarm could move plumbing without a single whale. But the weakness is scale. For many affected names, open interest looked too small to explain moves of that magnitude. Hedging likely amplified, but many doubt it was the sole cause. It may have been the gasoline, but something else lit the match. The domino path remains suggestive, not definitive. In the aftermath, regulators launched investigations, the SEC and FINRA. First task, collect and analyze. Public exchanges, dark pools and alternative venues, each with different formats. Stitching it into one timeline via the consolidated audit trail. The crime scene is technologically fragmented. Circuit breakers and limit up limit. Down bands aim to slow extremes and give humans time, but moves were so fast they often stayed within bands, or pauses were too brief to stop momentum. Investigators hunt manipulation like spoofing, large orders placed then cancelled to fake demand. Proving intent is difficult. Many legal strategies place and cancel orders. Distinguishing crime from aggressiveness is grey. Experts call for more transparency, faster dark pool reporting, more algo details, while industry warns of liquidity harm. Regulators weigh market stability against efficient, low-cost trading. The response is caught between safety and expense. Beyond machines and rules lies human psychology. Even in an algo-dominated market, humans watch. When they see nonsensical moves, their reactions can fuel the fire. Fear and greed are catalysts. Spikes trigger fear of missing out. People chase momentum, adding fuel. Plunges trigger panic selling, rushing to exit before losing everything. A small anomaly, glitch or whale, gets observed and amplified by humans and machines until noise becomes the signal. When belief in rationality cracks, behavior becomes unpredictable. Makers widen spreads or pull quotes, draining liquidity. Prices grow more volatile, frightening more players. A market-wide bank-run dynamic. The event was a stress test showing how quickly confidence can evaporate. A single cause may be a fool's errand, a small algo error, magnified by gamma, noticed by humans, triggering momentum in fragmented, thin liquidity. Not either or, but yes and, a perfect storm of technology and human emotion. The mystery matters because it strikes at trust. Markets allocate capital, directing savings to productive enterprises. For this to work, participants must believe in fairness and rationality. If prices detach, or the game looks rigged by machines or hidden players, trust erodes. Investors hesitate. Companies face costlier funding for growth, innovation, and jobs. The consequences are real. We built a system of breathtaking speed and interconnectedness, a technological marvel, yet opaque and sometimes unpredictable. We gained efficiency, but may have lost resilience. Speed outpaced our capacity to understand and control. The mystery reminds us, when we build systems we don't fully comprehend, we must expect the unexpected. The search continues in petabytes of trades. Regulators debate transparency, high-speed trading, dark pools. Academics model cascades. For now, it is law, a ghost story about fragility. Even amid big data and AI, some things remain out of reach. The market returned to normal, but that hour hangs like a question mark. We built the most advanced financial machine in history, yet we are still learning how it works. Do we really control our markets, or do they at times control us? If you enjoyed this, please like, comment, and subscribe. Thank you for watching.